Yesterday afternoon, at 2 o'clock, the Federal Reserve released the official minutes from its July policy meeting. Gold jumped 1.9%. Silver jumped 2.7%. Here is the detail I need you to sit with for a moment before anything else. Both of those moves happened before 2 o'clock. The market moved on this release before a single trader had actually read a single word of it. I want to walk you through what was actually inside those minutes, once they did land, who exactly is now on record pushing for higher rates, and why the very next event on the calendar, arriving in just a matter of days, could matter even more than what just happened. Here's the twist, and I am giving it to you immediately. Instead of making you wait, a market moving ahead of a scheduled release is not random noise. It is a signal of how tightly positioned and how nervously anticipatory the market has become around this specific institution's every word. When gold and silver jump before the actual content of a report is even public, it tells you that whatever this report says almost matters less in that specific moment than how on edge the market already was heading into it. That is not a calm market. That is a market bracing itself. And it got a real reason to brace once the minutes actually did land. Before I go further, I want to know who is with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly whether you saw yesterday's move in real time or whether you are only finding out about it now. I read these, and I promise you the pattern in the comments under a video like this always reveals how fast and how unevenly information like this actually spreads. Let me tell you exactly what was in the minutes once they landed, because this is the first time the specific details behind that descent have been made fully public. The Fed left rates unchanged in July in a range of 3.5% to 3.75% as expected, but three regional Federal Reserve presidents, Lori Logan, Beth Hammack, and Neil Kashkari, voted against that decision, formally pushing for a quarter-point rate increase instead. The minutes themselves stated plainly that the information available at the time of the meeting indicated inflation remained elevated, even while labor market conditions were described as stable and the economy continued expanding. And the policy statement itself, both in June and again in July, offered no explicit guidance about what comes next. A deliberate choice consistent with the current Fed chair's preference for reducing forward guidance and preserving flexibility from one meeting to the next. Put plainly, three of the most senior regional officials in the entire Federal Reserve System are now formally on record believing the central bank is not moving aggressively enough, and the institution as a whole has chosen to give markets less guidance about its next move than usual, right at the exact moment that internal disagreement is becoming public. If you are finding this useful already, take a moment to like this video and subscribe, because the next part explains why this specific combination, real internal disagreement plus reduced guidance, tends to produce exactly the kind of jumpy, anticipatory market behavior you saw play out yesterday afternoon before the report even landed. Here is why that combination matters so much. When a central bank offers clear, explicit guidance about its future plans, markets can price that guidance in calmly over time, adjusting gradually as new information arrives. When guidance is deliberately reduced and real disagreement exists inside the room, markets are left guessing, and guessing markets tend to react far more sharply and far more suddenly to each new scrap of information, because there is no steady baseline expectation absorbing the news gradually. That is exactly the pattern you saw yesterday, a jump before the content was even public, followed by continued repositioning. Once traders actually digested what those three names and that specific language about elevated inflation actually meant. There is a piece of technical detail underneath all of this worth understanding too, because it explains why the paper price of gold specifically has become more fragile right now than it might appear on the surface. Speculative short positions in gold futures fell sharply back in June, dropping around 35% in a single week, and have stayed low since. Those short positions, bets that gold's price will fall, normally provide a cushioning effect during pullbacks. because traders holding those bets eventually have to buy back gold to close them out, which provides underlying support during a decline, with that specific pool of short positioning reduced and staying reduced. Gold currently has less of that natural cushioning effect available. If a real bout of selling does show up, which is part of why the metal has been capable of sharper moves in both directions recently than its underlying structural story alone would suggest. Let me make this real with two people, because none of this matters until you see how it lands in an actual life. Neither is real, but both are the kind of person you might recognize. The first I will call Wilfred, 71, who checked the gold price around 3 o'clock yesterday afternoon, noticed it had already moved meaningfully higher, and assumed he had simply missed the window to understand what caused it, since by the time he looked, the news already felt like old information. He did not realize the move itself, happening before the actual report landed, was arguably more informative than the report's contents. A signal about market positioning that most casual observers checking the price after the fact never actually see. The second person I will call Clementine, 68, and she has learned to pay attention not just to what a report says, but to how the market moves in the hours immediately surrounding it, before and after. When she saw gold and silver jumping ahead of yesterday's 2 o'clock release, she understood immediately that this was a market bracing itself for something, and she read the actual minutes once they landed with that specific context already in mind, rather than reading them cold the way most casual observers do. Wilfred saw a price that had already moved and assumed he was late. Clementine saw the timing of that move itself as information worth understanding on its own terms. The difference between them was never how much either one had invested. It was that one of them only looked at the price after the fact, and one of them paid attention to the shape of the move itself, not just its size. Now, why do so many careful, engaged people end up like Wilfred, missing the significance of how and when a market moves? Not just how far. There is a simple reason. Most casual market coverage reports outcomes, the price is up, the price is down, without emphasizing timing relative to the actual news that supposedly caused it. A move that happens before a scheduled release is a genuinely different kind of signal than a move that happens cleanly afterward. But that distinction requires a level of attention most headline coverage simply does not provide, which means the people who catch it are almost always the ones specifically watching for it, not the ones with access to any special information. Now, let me be careful and honest with you, because I will not insult you with fear. And this exact subject draws people who want to frighten or excite you into a rushed decision. 3 dissenting votes and reduced forward guidance do not guarantee a rate hike actually arrives in September, and markets are still pricing meaningfully higher odds of the Fed holding steady than hiking. Reduced short positioning in gold makes sharper moves more possible, but it does not guarantee a decline is coming, and gold has continued posting real gains through this exact stretch of reduced short interest. Anyone telling you yesterday's move guarantees a specific outcome from here is overselling you a certainty that simply does not exist in a market this genuinely uncertain. What I am giving you is not a prediction of what happens next. It is the actual detail behind yesterday's move and the reduced cushioning currently sitting underneath gold's price, so you understand the real mechanics at work rather than only the headline number. I want to say a word about the calendar here, because the next major test is not far off at all. In roughly a week, the Fed chair delivers remarks at the annual Jackson Hole Symposium, an event with a real demonstrated history of moving markets sharply, sometimes within minutes, precisely because it offers a less scripted, less carefully hedged format than a typical policy statement. Given how tightly positioned this market already showed itself to be yesterday, moving before a report even landed, that same tension heading into Jackson Hole deserves real attention, not as a reason to panic, but as a genuine reason to stay informed, rather than caught off guard the way so many people were yesterday afternoon. So let us pull this together and go back to where we started. Gold and silver both jumped yesterday, before the Fed's own July minutes were even publicly released. a signal of just how anticipatory and tightly positioned this market has become. Once the minutes did land, they confirmed 3 named regional Fed presidents, Lori Logan, Beth Hammack, and Neil Kashkari, formally pushing for higher rates, alongside language describing inflation as elevated and a deliberate reduction in forward guidance from the Fed itself. Underneath all of it, reduced short positioning in gold futures means less natural cushioning is currently available if a real pullback shows up. And in roughly a week, an event with a genuine history of moving markets sharply arrives on the calendar, landing directly on top of a market that has already shown this week exactly how quickly it can react. Here is what I want you to carry away from this, stated as plainly as I know how. This is not a call to panic, and it is not a call to make any rushed move today, because balance and clear thinking matter, especially with retirement savings. It is a call to pay attention, not just to what happens in this market, but to when and how it happens. Because a move that arrives before the news that supposedly caused, it tells you something real about the tension already sitting underneath the surface. Whether any of this changes your own plan depends entirely on your own circumstances, your own timeline, and your own comfort with the kind of volatility this exact stretch has clearly demonstrated. And I am not here to tell you the number. I am here to make sure you are not the person checking the price after the fact, wondering what just happened, the way so many were yesterday afternoon. Do not let anyone use this moment to rush you into a costly decision, because there will be people trying. And they get louder every time a report this closely watched creates this much market tension. And do not dismiss it either, telling yourself that a market moving minutes ahead of a scheduled report could not possibly matter to your own plan because you just watched exactly how much information is sitting in the timing of a move, not just its size. Those are 2 different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, the specific price moves, the 3 named dissenting officials, the language from the minutes themselves, the futures positioning data comes directly from the Federal Reserve's own published minutes and public market reporting on yesterday's reaction. So you can verify every word of it yourself, rather than take mine. I open by telling you that gold moved before the Fed even released its own minutes yesterday, and that the timing itself was the real story. Now you understand exactly why a market bracing for real disagreement confirmed the moment 3 named officials, elevated inflation language, and deliberately reduced guidance all became public at once, sitting on top of a gold market with less natural cushioning than usual, heading into an even bigger test just days away. So let me leave you with the question underneath all of it. If a market can move meaningfully before the news that supposedly caused it even lands, how much of what happens to your own gold and silver in the coming days is going to be decided by a headline you read after the fact? And how much of it has already quietly started moving before you ever see it coming?